Hello there, I'm Dr. Stock, and in this video we're talking about CPI, which comes out Wednesday, which is May the 10th at 8:30 a.m. And I'll tell you what, this is one that I've really been watching because we want to see if we're going to continue to break the trend that we've had recently with the CPI, that we keep on moving in the downward movement or at least sideways. Either one of those would be fine as long as we don't go back up and continue on the trend that we were on, with March being just a fluke. So these April numbers, I believe, are highly important. So in this video I'm going to talk about CPI, and you'll also see me using the Moo app, and you can find the link down in the description for Moo. Just click the link, sign up, and the best offer they've given so far, you can get up to 20 free stocks for the sign up for the deposit of $1,000 or more. By doing $100 or more, you still get the 5 free stocks plus a little bit of a bonus in there. So please check that out. And also, if you like my commentary, like to hear more, check it out down in the description, that link for the Patreon. Click sign up. We'd love to have you over there as part of the community. Now on to CPI. So let's go to the calendar first. So here's the calendar that we got, and we can see on this calendar, brought to you by Trading Economics, we have Wednesday, May the 10th, 8:30 a.m. So this Wednesday, inflation rate month over month for March was 0.1%, and then for year over year is 5%. When we look at core, we have 0.4%, and then we also have 5.6%. Core is really part of what we want to pay attention to. We also want to pay attention to sticky CPI prices. I have that also available in this video when we look at it. So that core value, when we take out food and energy really drug down on this 0.1% that we had last time. Well, drug us down to that 0.1% from the other inflation measures that we had. And you can see when you take out energy from that, we're still pretty high up there. So as Jerome Powell keeps on saying, we're looking at services x housing. So we look at the sticky CPI, and like I said, I had that for you in the video. That's something we want to pay attention to. A quick look at what we have here. If I go to page 17, and I don't know why I wasn't already there, but here we go. All items less food and shelter, when we look at that, we get negative 0.3. All items less shelter, when we look at that, we get negative 0.2. And when we go down to services, less rent of shelter, that one you can see comes out to even when we take that out. That's awesome. Services in general coming out at 0.3. So if you pick down through the details of the CPI, you can see more of this as it takes place. I do like the St. Louis Fed as well. And when we actually go to that, so Fred, which is the St. Louis Fed, so when we look at that down here, you can see the trend that we were on since the pandemic, and higher highs, higher lows, and you can see June really popping up on us. That's important. You can see July really coming down to compensate, and then we started a new trajectory, almost resetting what we had, going all the way back to the summer of 2020. Now when we look at March, you can see that rounds up to 0.1%, because this right here is 0.05% month over month. That is nice that finally broke the trend, brought us down below this previous low that we had back in December. Like I said, you can thank energy prices for the main culprit in that. If we go over to core CPI x food and energy, when we see that, you can see the downward trend that we were on with the highs, the upward trend that we were on with the lows, and you can see that we sort of get stuck in the middle, and that's that sticky CPI as part of core that we see hanging around, that we don't have food and energy whipping us around on this. And it is nice that we didn't really return to trend with this high that we had back in February. That should have been a little bit higher than what it was, coming in at maybe a full 0.5, maybe up at 5.5. So we didn't get that though. Instead, we got the 0.45, which rounds up to 0.5, and then that followed up with something that rounded up to 0.4. So we'll see if we break down lower from this. That is very good when we look at the April numbers as they come out. So we want to come in under this 0.3, rounding down to 0.3 would be good. Back on the Trading Economics page, you can see their consensus estimate that they have comes in at 0.4 for both regular month-over-month CPI for all items, and for core coming in at 0.4, and it'd be nice to break those numbers. I don't think energy is going to help us out in April the way that it did in March. I think that April is going to be stronger for energy prices, and so I think that we'll see a higher read there than what we had in March's number. And then core CPI, seeing that come in at 0.3 as they are forecasting, as Trading Economics is forecasting, I think would be a very strong thing to see that come through. Now moving over to the sticky prices, so this you can actually get the economy now. They actually advertise it here. It's available on App Store, iOS, and Google Play. And this is the Federal Reserve Bank of Atlanta when you come here, and you can play around with the chart that they have. So what we're looking at, you can see in the legend down here, sticky CPI 1 month annualized. So these numbers are going to be the 1 month reading, month over month times 12 will tell you the number that we're looking at. So if you divide by 12, it takes you back to what you have for that single month over the previous month, and then 3 months annualized, so times 4 to get those numbers that you're looking at. And let me actually just do one at a time. Let's look at 1 month first, annualized, and you can see sticky CPI has actually started turning downward with this last month. So when we look at the annualized number for February, we didn't return to trend. Same thing for December and January. We did not return to trend. Those should have been popped back up, and they didn't. Instead, they start turning back down to where we come back to March, which goes even with what we had in December and November of 2021, and we'll see if it's something that takes us down even lower in the next one. If it pops back up a little bit, that's okay. We still just don't want to return to trend. Really, this is patterns over time, not individual values. So we want to see as it shapes up. So you can see the uptrend, the clear uptrend that we were on before, and now we started to tick downward. So let's put the 3 month back up there. And you can see it sort of smooths out the same curve that we're looking at. It's not so spiky, and you can see it lands us just a little bit higher, coming in at about 5.9%. Remember, that's annualized, so if you divide that before, you're around that 1.5% value for 3 months at a time when we look at that. So CPI, it's not going to be the biggest market mover that we have. However, it does tie in with what we have coming in from the Fed. So we're looking at June's numbers. I'll refresh this to make sure it is the most recent numbers that we have for June, and there it did change. So right now, a pause is still predicted by the bond market. When we look at this at 82.3% likelihood that we have the Fed pause in June. That's been talked about for a long time now. You can see there is a substantial likelihood that we still see a 0.25% raise. CPI is going to influence that, but we get May's read and we get April's read and we get May's read prior to the FOMC meeting. So these are really, really important values that we have, and really that rate raise, especially if we have the credit crunch possibly on top of that, if lending standards have tightened and continue to tighten, where it is harder to secure funding for future projects for businesses or for consumers to keep consuming, then that is stuff that could spell trouble for the economy. So it really is impactful when you look at these numbers, and it's important that you understand where they're coming from and how they can affect the markets. So I will put out another video. I actually have a tab up here. If you have eagle eyes and can read this closely, if you have a high enough definition of the video, it's a document that I make called What Will Move the Market. So I'm going to put that up for you in the next one. There's just not time to fit that in this one, but I do want to talk about that specifically in my next video that I put out for you guys. So let me bring that down, and I want to show you instead the chart that we have here, and this is the desktop app for Moomoo that you're looking at. And remember, you can find that link down in the description, and you can get up to 20 free stocks for that sign up. You're supporting yourself with that free cash just by signing up. It's effectively free cash because you get, once they're your shares, you can do what you want with them. You can sell them off, you can keep a hold of them, and each one of them is valued up to $2,000. So take advantage of that. And also earnings season, they have the earnings calendar in there, and the earnings center that they have is phenomenal. Let me move on from that. So here's the thing that concerns me when we look at the Qs, is this sort of mostly sideways movement that we have, but it is somewhat of an upward climb, and we have a falling momentum indicator here with the RSI. And if we see that go back down into bearish territory and these tops continue to fall down on us and we start putting in lower lows, that could be something that could spell for us that we have bearish divergence, and that could be a signal that the market will drop down. Now, when you look at the candles, this most recent candle we have, the Bears lost out today, the Bulls won out today, and you can see we kind of just came across and closed right out these previous highs that we had. We are trying in this market, we are trying in the Qs, tracking the NASDAQ 100, we are trying to retest this last high that we had going all the way back to August the 16th is where we peaked out the last time. And it's not too far up above where we closed. And like I said, the market does keep pushing up on it. And I am just a little bit concerned as well about what happens to the market then, especially if the momentum keeps on falling. Will we end up back in bearish territory? We're just gonna have to watch. And you can tell looking at the momentum here how we spend most of the time up above 50 in the RSI, bullish, and look at the action that we had. And then when you can see this long-term downtrend that we were on, even though we broke back up above that 50 in the RSI, we still spent most of the time below it. Well, when you look more recently at what we've had going all the way back to October, is we spent somewhat of the time down beneath it, but most of that time has been spent up above 50. So, well, we've had that bullish movement. We want that momentum to hold out. And so this is really the first time that I see looking at this chart where we really get significant upward movement, even though it's been somewhat sideways, it's still been somewhat upwards, but we are falling with that. And this low If that low was even lower, dropped even deeper into bearish territory below 50, but not quite 30, below 30 would put us at oversold, then we could stand to bounce up from there. If we get another lower low, we don't get to peak out above these highs, and that bearish divergence continues. That makes me even more cautious about what we're seeing in the markets. I also, with the NASDAQ, worry about the concentration in big tech, and what happens if they start reporting soft earnings. That could be something else that could impact it. So the cues right now, with what we see with the CPI, it is possible that we get a more hawkish Fed if we get high reads. We get a Fed that continues to be moderately dovish, I would say. If we get decent reads that fall in line, showing that inflation is either holding steady or even better, starting to fall. Those are things that could really electrify this market that we see here. And if we have news coming out that the credit crunch is not nearly as bad as we thought, and that lending standards are not tightening as bad as we thought, that is all fuel for the fire to move this thing up higher and breaking above this peak. If we break solidly above that 328 level in the Qs, like, rally on. That is going to be incredible. We do want to watch that. So breaking it on good volume and breaking it on good momentum, staying below 70 so we don't get into an overbought territory, because that could sell back off on us. So CPI, as we know it, as an inflation indicator that we have. By the way, PPI is the very next day, Thursday, May 11th, so keep that on your calendar as well. That could be very forward-looking for the inflation that could be passed on from the producers to the consumers. We want to be aware of that. We want to be watchful for it. I think that's another video that I need to put out for you guys. So the markets, right now, we still have that big decider coming in. I think the CPI coming out for April, April's report that comes out, I should say, on May 10th at 8:30 a.m., that could be significant. If it lands us somewhat in the middle, somewhat mixed, I don't expect it to move the markets very much. If it comes in lower than expected, and if sticky CPI starts to push down even harder from where we were at, which I believe on the monthly annualized chart was at 4.7, so if that comes in below 0.4, if that comes in more like 0.3, which then annualizes to 3.6, that is going to be very bullish for the markets, and it is very much worth paying attention to, because that could really help to signal a better Fed pause. I do also have on my mind now the market pricing in the Fed cutting rates at some point in time, but I believe that will only happen if they believe that something is broken. So I don't think that in 2023 we see the Fed cut rates unless we see signs of serious deterioration. So deterioration, I don't know how I said that, but if we see serious deterioration, maybe I did say it right the first time, in the economy or from the consumers, the consumer makes up about 70% of GDP. If we start to really lean into recession, that could be something that could significantly impact what we see in the markets, because it impacts the earnings of the companies, which means that they'd be trading at a richer PE, and that is troublesome. That makes for a shaky market. So we want to be absolutely watchful for that. So the CPI could be a big indicator on what we see coming out from the Fed, and maybe making a better case that they stay dovish, that they pause where they're at, and even possibly making a better case that we get rate cuts sooner than later. But like I said, I don't think we get the cuts in 2023 until we see something break. So if we don't see anything break in 2023, I don't think we cut rates on, the Fed cuts rates on us. And then 2024, I think it would be more that time that we would start to see that. So we'll have to keep an eye on it. Like I said, I'll put out a video on what I think it'll take to move the market out of sort of the stall that it's in right now. The bulls are slightly winning, but I want to know, I want to be on the side, because I do have a short hedge build out that I am building up over time. I continue to dollar cost average into it, and I also have a lot of long positions that I continue to dollar cost average into. One of my favorites recently has been Tesla. When they just got wrecked by their last earnings, it put me in a good position to acquire some more shares of them. So that's just one of the shares that I have for you. Check out that link for Moo down in the description. Check out the link for the Patreon. While you're there, click sign up. Check out the Patreon exclusive commentary and be a member of my private Discord community. We absolutely love to have you over there. Like I said, Moo, best offer I've seen. Go ahead and check it out. Like this video if you liked it. Hit the subscribe button to see more of my content. Ring that notification bell to see any time that my new videos come out. I am Dr. Stock, Doctor of Education. We'll see you in the next video.